Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. The U.S.-China tariff truce holds, with both sides agreeing to extend the pause for a further 90 days. Now, Beijing also pledging to suspend or cancel non-tariff measures.
Asian stocks, meanwhile, trading higher. Japan leading those gains ahead of U.S. CPI. And Australia's Reserve Bank expected to deliver that cut later on today.
And the search for a new Fed Reserve chair expanding, with the central bank's two vice chairs and the Dallas Fed president now said to be in the running. Welcome to the show. We didn't have to wait all the way to the deadline. We now know and have confirmation, of course, on the trade truce extending for, let's call it, go towards the latter part or the mid part of the fourth quarter. Can we rest easy for now? What does it mean for markets which have done well? And of course, overnight, we're still feeling the tailwinds of what we got in Wall Street. Of course, NASDAQ at a record. The Nikkei's reopening today after being shut on Monday for Mountain Day. And as you can see, it's playing not just catch up, it's lifting the benchmark. And then it's now also trading at all-time highs. So we'll see whether that continues going into today. A lot of event risk on the table, notwithstanding some macro conversations around the RBA and, of course, the Fed that goes into the CPI print coming out of the U.S. later today. Speaking of, in terms of the macro, on the macro front, the Aussie dollar might actually be feeling the China-U.S. truce more than the RBA. It depends, of course, what the RBA will say and do and how they say it. But in the meantime, of course, constructive on risk. U.S. two-year yield ahead of the U.S. CPI print, and of course, gold futures now more clarity coming out of Donald Trump. Say no tariffs on gold with an exclamation point as well. There we go. Right, flip the boards, please. Overnight, here's a story as well. So iron ore futures going into today had been feeling the tailwinds, and this recent report, not anti-involution, but perhaps that also goes into that as well, but effectively less supply coming on the table. This report suggesting that some steel mills are being asked to halt output towards the end of this month, which is one reason why we're looking at the entire metal space, as you can see on your screens, this reflation trade, which, by the way, Citi's saying don't chase that. All right, Golden Dragon Index, a couple of big movers overnight. Alibaba, one to watch going into today, and XPeng was up about 6%. I think when you look at how the stock is actually trading, might be exhibiting some signs of overheating. Right, very quickly, the approach to the open today. We talked about reflation. 10-year yield had a big move up yesterday to about 172, 173. Want to watch as we go into today. And, of course, we're looking at some declines here. And, again, within that, Shanghai Composite, and we are moving as well into earnings season across major parts of the mainland market, Yvonne.
Yeah, as you mentioned, those reflation trades, that City line was quite interesting, right? They really compare it to what happened back in 2015 and saying, look, it's not the same, which many of you guys have told us. Because at the end of the day, you're still talking about a time where we aren't seeing the big stimulus that we did back in 2015. So when you're raising prices of commodities and the like at a time when consumers and the like are not spending, does that actually backfire at the end? That's certainly one thing to say. So they say don't chase the whole rally when you're starting to see what yield curves are steepening, equities are being bought out as well in China. So certainly that's one thing to watch. We talk about the earnings picture, the likes of Galaxy. We just had 10-year report as well. So we'll get you a preview of that. Kweichow comes out a little bit later on as well. We mentioned that rally in the Shanghai Composite. We're still in that window for credit data as well as we count down to that data dump at the end of the week. And yes, XPeng and Xiaomi, ones to watch, as Dave had just mentioned there as well. But yes, it's all about that trade truce, right? As you say, it's no secret that everyone is maybe priced in that this was going to be rolled over for another 3 months or so. Wonder how big of a relief it is for the Chinese right now.
Yeah, given the fact that a lot of the front loading had already been taking place along some of the proxies, and the economy is actually doing well because of the first half of the year. And what does it mean for the second half and what gap that remains? The other thing as well is, given it's 90 days and given how markets have done well, what now, right? Yeah. What is the catalyst? And I think one of the notes that's come out is that there isn't any visible potential negative catalyst in equity markets, which have done very well. Apart from, I guess, valuations, which have been a feature of this rally for some time now. And I think the latest Bank of America Fund Manager survey does suggest that 91% of the people they surveyed actually think U.S. equities are overvalued at this point in time.
Yeah, they still think no sort of hard landing. They're still thinking maybe soft landing is most likely outcome in the global economy in the next 12 months or so. But it does go to show that, overall sentiment is the most bullish they've seen in 6 months. So maybe we're seeing things are a bit crowded in the equity space as well. You could say that for a lot of markets here. In Asia also, right?
Japan.
Not just the U.S. Yeah.
Japan, Taiwan, I think JPMorgan will be joining us later on, Tai Hui, and he is of the view that when you look at North Asia, Taiwan actually might have more room to go. Kospi, maybe not so much. They're fairly bullish on China. And I think the interesting, too, is the fourth bullet point on the screen, right? So while 91% of respondents think the U.S. equity markets are overvalued, there is no bubble based on a slight majority as far as that's concerned. So I think, anyway, we'll unpack all of these things later on as well, given the now detente that's been extended as far as the trade conversation goes.
Yeah, Bloomberg Economics says, look, it's basically a truce, it's reprieve, not relief for China, given the fact that you take a look at some of the trade deals that the U.S. has already made with other parts of Asia. This still puts China in a weaker position here. And this is one of the few that still have no timeline of what this trade deal is going to look like. But yes, that is the news of the day, though. They signed an executive order extending that truce for at least 90 days. In a social media post, he says all other elements of the agreement will remain the same. China, for its part, says it's suspending or halting all non-tariff measures against the U.S. And meanwhile, Trump is also signaling he's open to allowing NVIDIA to sell China a scaled-back version of its most advanced AI chip. So there's a lot of sort of horse trading, I guess, going on still. Let's bring in Gong, professor at the University of International Business and Economics in Beijing. Okay, so we have another 90 days. There's a bit of breathing room between the two sides, John, but where do you think things stand right now, you think, between the U.S. and China?
Well, I think this is going to be the new normal we're going to face as we move forward. I think President Trump is going to continue this practice of every time extending this deadline for 3 months. And he's using this as a bargaining chip, essentially. This time he said he wants China to quadruple the purchase of soybeans. And I think next time he's going to say something else. It's quite interesting to see that he didn't demand China stop buying Russian oil this time, as he at the same time slaps a 25% on India for doing the same. That's quite interesting. But my guess is that the next time he's going to raise something else. So it's going to be like this, for many years to come, towards the end of his administration. This is the new reality. I think, companies engaging China-U.S. trade all understand this. They've been preparing for this. And some of these companies actually diverting trade away from American markets. If you look at the statistics, America's share of total China's exports has been steadily coming down. It has come down to a little bit over 9%, which is not something that's sort of very significant, very something totally indispensable to China. So I think China is ready to respond every time Washington slaps on higher tariffs, and Washington takes precautions for this kind of a reaction. So I think we're in this kind of a very delicate equilibrium, and this is going to be continuing for some time.
Professor Gong, this is David. The view that Donald Trump has gone softer, not softer on China, is that view, I'm curious, shared on the ground there on the mainland?
Well, I won't really characterize as soft. I think President Trump has this, very obvious trait that he's going to be bullying weaker guys, weaker countries, but respect the stronger countries. Now, keep in mind that China is the only country that retaliates against American tariffs by increasing tariffs of American imports into China. No country has ever done that. And President Trump patently threatened any country of doing this, but China did. That goes to tell that China is indeed negotiating from a position of strength, and this is how to deal with President Trump. I mean, he has this kind of a nature. You have to treat him as a real opponent, and if you're showing weakness, you're going to get nothing other than just disdain and bad treatment. He's not going to be sympathizing any weaker guys.
But getting a cut out of revenues to China, which is what reportedly has been struck between the likes of NVIDIA and AMD, I'm just wondering, how do you view that sort of trade policy now? It seems like the sort of pay-to-play revenue for export sort of trade approach, is this sort of the new trade policy out of the U.S. or just, cost of doing business in China now?
Well, I think, first of all, it raises a constitutional issue here. I mean, there are people in the United States saying this is against the Constitution. U.S. trade law prohibits collecting tariffs on exports, but he is doing this. This is essentially export tariff. There's no doubt about this. And my view is that, this is another example of showing what the Trump administration is all about. It's all about money. It's very ad hoc. It's all about collecting revenue for the government. I think, this is very characteristic of Trump's style. He cares about money. He wants to collect money, and it's very transactional here. It's unprecedented that the U.S. government is actually collecting 15% tariff on its exports, unprecedented. But the thing is that these two companies, AMD and NVIDIA, they're not going to go to court to challenge that. Just as many American institutions haven't challenged Trump's sort of very heavy-handed decisions, they've chosen to essentially seek a compromise with the Trump administration. I think this is okay. I mean, it's America's business, but ultimately, I think it's going to gradually and slowly erode the constitutional rule in the United States, which is something very worrisome.
And I wonder then, I mean, is then the sky's the limit then, right, on what the Trump administration can target as the next bargaining chip? What sort of companies or industries do you think are next?
President Trump is luring by issuing these executive orders, decrees, and he's doing these ad hoc things, and he's trying to collect as much money as possible. And the next industry that I think he is going to target to try to promote American exports may very well be Boeing airplanes. I mean, the Boeing company is not having a good time these days. It is, having a series of scandals in its losing market share to Airbus. And I think probably Trump wants to reverse that tide. And he probably next time he's going to demanding China buying more Boeing airplanes. That's a quite possibility, I view.
Yeah, I mean, it partially offsets the trade relationship and the exports, which goes into my next question, Professor Gong. What is your outlook for exports going into the last few months of 2025 as it pertains to Chinese exports to the world?
Yeah, well, I mean, this is actually very telling that amidst a whopping 11% drop of Chinese exports to the United States, China's aggregate exports to the entire world, that's the total statistics of China's exports, increased by 7%. That tells a lot about the importance of the American market right now. As I said, the total share of American market out of the total China's exports market is just a little bit over 9%. And I would even argue that it will further drop, maybe another 2 percentage points as we move towards the end of the Trump administration. So I think, I've been advocating this view for quite some time. What President Trump has been doing is just to try to upend and to some extent eviscerate the WTO, which is the core of the rules-based international order in commerce and the economics area that the United States helped establish in the first place. And his view is that this is totally against him for the last several decades, and he wants to get away from this. So I think we are entering a world with two parallel systems. One is the WTO-centered system. I call it N-1 system. The United States is getting away from that. The other one is a U.S.-centric, a set of bilateral relationships between Washington and its trading partners. So these two parallel systems will go on for some time. And as a result of this, I think America's America's trade as part of the total global trade is going to decline. With such high tariffs, obviously, it's not going to be increasing in trade. It's going to seem less of a trade, and that's why its total weight in the total global trade is going to further come down. And this is a path that the Trump administration chooses to do. And I don't see any other reasons or factors that's going to stop this trend.
How quickly things have changed, Professor Gong. Thank you so much. Just over 2 decades since the U.S. let China into the WTO. Here we are looking at almost the complete reversal of that mirror. John Gong, professor at the University of International Business and Economics, joining us there out of Harbin this morning on the mainland. Right, coming up on shows, the White House is set to expand its list of contenders for the next Fed chair. A closer look at the candidates coming up. Also counting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong. This is The China Show. Welcome back. More on our top story today. We're getting more details on this extension and what China is doing on their end. Let's get Min Min, our China correspondent, with this Ministry of Commerce statement and what they're doing here. Min Min.
The Ministry of Commerce reiterated that they are suspending some of these non-tariff measures that had been agreed to during the Geneva deal. So these 28 U.S. companies that have been included in an export control list, initially the rule was that China will not be able to sell any dual-use goods to these companies. Most of them are defense contractors like Lockheed Martin, Boeing Defense, for example, but that is going to be suspended for the next 90 days. Again, this is not new, and as has been mentioned before, this is a well-anticipated sort of trade truce extension for another 90 days that basically kicks the can down the road, buying both sides more time as we work towards this potential meeting between President Xi and Trump sometime before the end of this year, potentially in October at the sidelines of the APEC summit. And there's still a number of issues on the table, right, including, the removal of the fentanyl-related tariffs, the 20%, that's what China wants. The U.S., of course, had been threatening these additional tariffs for Chinese purchases of Russian and Iranian oil, also calling on China to quadruple its purchase of U.S. soybeans as well. And of course, there is the latest development as well, the U.S. looking to potentially loosen some of the tech restrictions to sell the latest NVIDIA Blackwell chips to China, scaled-back version of that. That's potentially on the table as well.
All right, Min Min, thank you with an update. Coming through in that statement this morning, our China correspondent Min Min Lo there. Let's get to another top story that we're tracking for you today. The Trump administration is said to have expanded its list of potential new Fed chairs. And officials say the central bank's 2 vice chairs, Michelle Bowman and Philip Jefferson, are now under consideration, along with the Dallas Fed President Lori Logan. For more, let's bring in our Bloomberg Director of U.S. Economic Research, David Wilcox. He joins us from Washington this evening. David, thank you so much for joining us. The list seems to be getting longer. Can you tell us, when you take a look at it, who are the serious contenders to really succeed Jay Powell?
It's good to be with you. I think the 3 top-tier contenders remain the same as they have been for a while now. There are the 2 Kevins. Kevin Hassett, a longtime advisor to President Trump, his chair of the Council of Economic Advisors in the first administration, and now his National Economic Council director. Kevin Warsh, who was a former member of the Board of Governors through the financial crisis and played an important role then in helping particularly assemble the political constituency, the backing in Congress to support the extraordinary measures that the Fed took. And Christopher Waller, a current member of the Board of Governors, who's been particularly vocal in making the case lately that the Open Market Committee should marginally ease the stance of monetary policy. Those are the top runners in my estimation.
Okay, now the possibility that Jay Powell remains on the board, even after he's no longer chair, there's, we've seen it in the past. Do you think that he will do it? He will remain quite literally on board?
It's a tantalizing possibility for those of us who, among other things, are amateur historians of the Federal Reserve. There is, as you mentioned, historical precedent for that. A very famous member of the Board of Governors and chair, Mariner Eccles, did exactly that. He's has the headquarters building named for him. And when President Truman declined to reappoint him, he stayed on the board for another 3 years. So it's perfectly within Chair Powell's legal right to do that. His term as governor extends another year and a half after his term as chair expires in May of 2026. He's been conspicuously coy about whether he'll do that. And my guess is that he himself doesn't know yet. He's probably, or perhaps, waiting to have a look at who President Trump names as his successor, and maybe he'll make a decision at that point.
And David, it's interesting, right? Because the markets seem to be kind of going with it that, the next Fed chair is going to be dovish. But, it's just one position and there's still a board. So how big of an influence could a new chair have on monetary policy?
It's a good point. Not only is there still a board, and that's the relevant governance organization for financial regulation, there's a wider Federal Open Market Committee, which is the relevant organization for monetary policy, and there the chair is just one vote out of 12. Albeit, admittedly, the most important and influential vote out of 12, the first among equals, but still, the chair has to persuade others to go along with him or her. And so whoever takes the position will have to be credible, will have to assemble a coherent, analytically grounded argument for others in order for if they're going to follow in line.
Yep, and there's still a dual mandate. I got to get your take on the CPI print that's coming out later on in the U.S. on Tuesday. What's your projections of what could happen?
Well, a lot of analysts, myself included, are looking for a little more evidence of tariff pass-through. And if that happens, that's going to put the board of the Federal Reserve in a pretty delicate, difficult predicament, because what they'll have at that point is increasing evidence of inflation that's heating up a little bit, going in the wrong direction from the 2% objective, and a labor market that seems now pretty clearly to be easing, especially in light of the most recent jobs report that showed a soft number of jobs added in July and a really large downward revision to May and June. So they'll be faced with a dilemma, a classic dilemma in monetary policy, weakening economic activity and heating up inflation. That's going to be a tough predicament for them to make a policy decision on.
Conflicting signals. David, thank you so much. David Wilcox there, our Bloomberg Director for U.S. Economic Research. Fantastic preview of really just number one, the short-term CPI, and of course the possibility of what personnel changes means for policy prescription. That's your triple P today. Two charts before we get into the open today. We've been talking about the Shanghai Composite here. So, this whole going long on Chinese banks, and a lot of them are the largest constituents of the Shanghai Comp, has actually now pushed the actual index, this specific index, to within 2% of this high right here. Beyond that, we're back to what? Guess what? 10 years ago. And that means as well is that if you had to pick a benchmark, right, Shanghai Comp or CSI 300, because of this index construction, the Shanghai Comp has actually outperformed. You have to go all the way back to 2021. In fact, you trace it back to the September low last year, and that ratio, if you take one over the other, is now at the highest in about 8 years or so. So again, lots of brewing conversations around, is this a popular trade, Yvonne, because there's no other alternative, apart from, of course, what's happening here in Hong Kong. Everyone buying into these dividend plays on the mainland.
It still seems to be the defensive play.
Yeah.
No matter how far you lean into risk. I keep hearing barbell.
The barbell strategy.
It's still there. All right, pre-market's looking like this in Hong Kong here right now, and we are still seeing here when it comes to this downside we're seeing in stocks here today. So we're down about a third of 1%. That, of course, is despite this trade truce that we're seeing. Maybe it was largely priced in. HS Tech is on offer here today, and 8 shares are just teetering around that 8,800 level here, 719 for dollar China. We did get that fix here from the PBOC. Was slightly to the stronger side here as well. In terms of stocks to watch, there's still that earnings picture that we look at today. We're going to get a preview coming up. So Galaxy and Wharf for the ones that are reporting a little bit later on as well. Kweichow, we're going to talk about Tingyi as well. And also Xpeng is what we saw in the ADRs, which really was lit. Well,
oh, we're down now. Yeah. I mean, we were expecting a pullback at some point, given how overheated the stock was looking. So that's among other names. Coming up next, the Open. 3 minutes away. This is the China Show. Good morning. Good morning and welcome back to shows. We're looking at maybe a soft open, likely a soft open. Whether we remain in and around these price levels remains to be seen. Apart from this, though, the rest of the region is doing well. I mean, a lot of that is also because Japan is reopening today, so that's a catch-up trade, and the Nikkei is now at a level that we've actually never seen. So all-time highs in the Nikkei, that's lifting the benchmark. Taiwan is also doing quite well, actually, today, continuing to do that. Trade on AI has really benefited Taiwan a lot.
It certainly has, and whether it still has legs is still one thing to watch as well. But China certainly has that sort of flavor to it all, to this rally that we've seen as well. So certainly that's one to watch. We're talking about the mainland and some of the superlatives that we're really kind of getting close to. The Shanghai Composite flirting with those 10-year highs, that's certainly one thing to watch. But today it seems like we're taking a little bit of a back foot, at least in Hong Kong. Onshore is doing quiet, right? We're pretty much flat on the CSI 300 as well, but we are within that 2% of that peak that was set for the Shanghai Composite back in 2021. So that's one thing to watch as well. When it comes to bonds, we talk about the pickup in yields since July, basically, and that seems to be taking a bit of a pause here today, but certainly it is part of that reflation trade. Citi just coming out with a note saying, maybe don't chase it, because we're not quite sure whether this anti-involution campaign can really replicate the sort of success that the 2015 supply-side reforms had. And they've highlighted the issues regarding that here as well. So certainly that's one thing to watch. There right now we're watching, of course, their earnings. CATL, I mean, that was a big story yesterday when it comes to lithium. We'll still watch what plays out there, just given what happened and them halting production in that mine. It certainly does lead to a lot of questions about whether this is the latest target in the whole anti-involution campaign. But it seems like it's getting momentum, right? We talk about iron ore. Yes, they talked about this consultancy firm basically reporting that some steel mills had to also halt production temporarily as well. That's why you're seeing Dalian futures of iron ore up 1.5% or so, and really mimicking what we're seeing in the Singapore futures, which did react first as well to that news. You take a look when it comes to the Hong Kong dashboard as well. We talk about earnings. So Galaxy, Kweichow, we're talking about Tingyi as well. So here's some of the ones that we'll be highlighting a little bit later on the next hour as well. But it seems like tech is the one that's selling off a bit here today. Alibaba is down about 1% as well. The property side is doing okay, but we're watching very closely what happens with tech in particular here today, given we are just days away from some of these big earnings coming out from Tencent, Alibaba as well. HS Tech is down about 0.5%. Steel stocks are in focus, given what we see the movement that we're seeing in the iron ore price as well. There is a mixed picture among some of these steel miners as well, so not a clear picture so far. But then again, we're watching still this whole CATL sort of story, right? So Citi opening up this 90-day positive catalyst watch on some of these battery material makers. So Hunan Yunen and Shenzhen Dynamic. I say that right. So they're thinking
Why is that the name, though?
I don't know. It's a tough one.
Yeah,
Dynamic.
Okay.
The nation's drive to curb excessive competition will help improve the outlook for profitability. So that mine suspension they're citing from CATL could be part of that anti-involution initiative.
Okay. Yeah, I mean, so it's the entire exercise has really borne a lot of notes coming through out of the sell side, talking about how could benefit some parts of this as well. Right. Let's talk about the Chinese markets, what this means in a greater stack of things, and also within asset classes, equities versus fixed income, 90-day truce. There's a possibility of now who might be leading the Fed. Our next guest actually favors Chinese markets. Tai Hui is Chief APAC Market Strategist at JPMorgan Asset Management, here with us on set in our studios. Let's start with China, the call on China. You still like the market. Tell us why.
Well, I think there are two things. One is that there are some new potential earnings drivers coming in. You mentioned AI and technology. I think that's really important, especially since the start of the year. You do see government providing more support to the sector. And that's the first point. The second point is I think a lot of these longer-term challenges facing the Chinese economy, the housing market, the labor market, they're not fixed yet. But I think investors have already seen some stabilization, and that will allow for a repricing of some of these stocks. So, and finally, of course, the U.S.-China relationship seems to be in a more stable phase. Of course, there will still be ups and downs going down the road, but at least for now, the two sides are negotiating. We are seeing some relaxation on rare earth exports as well as semiconductors exports from the U.S. to China. So I think overall the environment, the backdrop for Chinese market is a bit more constructive compared to the last couple of years.
Yeah. Is valuation a key driver now?
It was. I think definitely, 6-12 months ago, valuation was very much a key driver. So the re-rating helped this particular leg in the last 6 months. But I do think now we need a bit more of an earnings momentum to support that valuations. I think the other thing to bear in mind is, I think if you think back to 2023, 2024, we spent a lot of time hoping, praying for stimulus because the economy required it. 2025, I think investors are more comfortable with companies being more independent to generate earnings. So even when we had good data coming out from the Chinese economy, the market reaction was still fairly positive. I think last 2 years, when you had good numbers, market was disappointed because that means stimulus could be further delayed. I think this year we've seen less of that disappointment, which I think is a positive sign for the Chinese market.
What specific opportunities remain, I think, tangible within the Chinese market? So people talk about tech, you talked about that. On the other side is the barbell strategy with banks and dividends. I guess you talk about the two banks, or apart from those, what else is on the table?
I think it does depend on the investors' objectives. If they're looking for income and relative stability, the banks, high dividend stocks, last couple of years, energies, telecommunications, they've actually done really well, despite the index have done quite poorly. However, I think if you look in 2025, 2026, we are looking at more on the technology side, especially not just the tech companies, but also those who can adopt and integrate artificial intelligence into their business model, which we're starting to see in financials, in healthcare. So I think these are the areas that we are observing. You guys mentioned the anti-involution drive just now, how to reduce excess competition. I do think we have to be quite careful with this theme because if you think of the whole supply chain, whether it's batteries or EVs or any other products, the demand is the ultimate driver of profitability. If the demands are the end consumers are not spending more, you're basically just reshuffling earnings along the supply chain. So you might benefit one part of the supply chain, but the other part gets squeezed. So again, I think it's not going to benefit everyone. It's going to be more a sector by sector or different segment of supply chain that you have to choose from.
Okay. And is it good to chase some parts of those sectors then now in this rally? That seems to be you seeing it, right? It's the solar, it's basically commodities one day, and then it's food delivery the other. Do you chase it?
I think it's going to be quite challenging, especially with policies coming out, every other day. But at the same time, I think you have to ask the question if, for example, in EV or battery technology, what is the role of pricing and volume and technology? For example, in battery technology, the market leaders are there not because they produce the most, but because they've got the best technology that can carry the industry forward. In EV, obviously you've got the giant, I can't name names, but you know who it is. And then the question then becomes, who will benefit if the level of competition does come down? I suspect it's going to be the one level down, not the small companies that are struggling right now. Those who are struggling today could still face elimination 1, 2, 3 years down the line. So I think it's going to be a case-by-case, sector-by-sector selection when it comes to looking for opportunities when the government is looking to reduce excessive competition. And the reality is, anywhere in the world, much of the policy have been trying to promote competition. There's been not a lot of research or academic work done on how to regulate or reduce competition. So I think this is a right call, but it's also quite an adventurous call in managing this type of competition.
Yeah, I mean, the whole, I'm going to coin a phrase right now, Chinese exceptionalism. They tend to overshoot to the point you're making, right? You're trying to promote competition. Yeah. Arguably, they've done it too well. There's too much competition, and I know you can't name names, but one specific stock, the market sold down, car maker because of that. Can I ask you about U.S. markets?
Sure.
Think of earnings season. We're done with almost a big tech. There's one more. I can't name names remaining.
Well, you can. I can't.
Okay. It lacks a vowel between the first two letters. Yeah. Are you concerned about valuation there? index level?
Not as, but at the index level, I think, well, you've got the big seven, Max 7, you've got the rest of the S&P 500. I would argue that the valuation in both sides are fair. The reason behind that is I'm a bit concerned about the U.S. economy. You're starting to see some slow momentum in consumer spending. We are going to get retail sales numbers this week. But a lot of these earnings reports have highlighted that consumers are starting to spend less, for example, dining out. So I think the cyclical part could face a bit more challenges in the second half of the year. But for the technology companies, often when you think about PE, it's the next 12 months' earnings. So you're talking about a company with a 30, 35 times PE, you're assuming growth of, let's say, 20% in the next 12 months. But if some of these tech companies can maintain that 20, 30% earnings growth over the next 2 or 3 years, or even next 3 to 5 years, then that PE ratio suddenly looks a bit more reasonable. Now, that said, not all Max 7 companies will win out the AI war. They all invest, they all have to keep putting the money in to stay in the game. But eventually, like in internet, in like social media, in e-commerce, eventually 1 or 2 companies will come out on top. So that's where I think active management plays a key role in not predicting just the next 12 months, but the next 3 to 5 years, which of these companies will have the most successful AI model that will be adopted, that will be the gold standard. That, to me, is the most important question.
How much does the Fed factor in now? Because we were just talking to our colleague in the U.S. and saying that there's a bit of dilemma now. If you start to see higher tariffs feed through into inflation, for example, at a time when the labor market is showing quite signs of cracks and slowing down, should we be preparing for some sort of stagflation scenario now?
I think the direction will feel like stagflation, as in you will get some pickup in inflation, but weaker growth. But the good news on the inflation, and we'll see more tonight, is that you do get imported goods being more expensive. But fuel, rents, services, the inflation is coming down, so that's offsetting those more expensive imported goods. So your headline inflation could still be around 3%, which is still above the Fed's target. Now, it's a great question about the Fed because I think the mood on the market has changed significantly after non-farm payroll. So I think the general consensus is that the economy is showing some signs of weakness, and therefore the Fed should move forward the rate cuts. Now, I think this depends a lot on the Fed's interpretation now, because in the last meeting, you start to see a few more governors and voters voting for rate cuts. And if the interpretation as a group becomes tariffs, inflation is going to be a one-off, it's temporary, it will be over, then I think the case for rate cuts as early as September becomes much more solid. So let's see what Jay Powell's going to say in Jackson Hole at the end of the month, and let's see, what the inflation number tells us tonight. But I think there could be an argument for positive or upside surprise in inflation, yet the Fed can still do some mental gymnastics and argue, the room for rate cut or the justification for rate cut is still there.
The way you phrase it is interesting, and I like that, because you can really make the case for one cut, an insurance cut.
Yeah.
4 straight cuts, you have to do a bit more mental gymnastics. And the reason I ask you that is, do you think that's the assumption market should have, that rates are going to go down 100 basis points within the next 12 months? And what does it mean for fixed income right now, which has been held hostage because the Fed has been held hostage?
I think 100 basis points in 12 months makes sense. I mean, ultimately, we're still in a above long-term average level of policy rates. So, if we were right that the economy is slowing down, growth could just get back to, let's say, around 1%. Unemployment gradually creep back up towards 4.5% or even higher, then the Fed returning to neutral, I think, makes a lot of sense. Which also means, in the fixed income world, first of all, you see short end of the yield curve is already reacting. The long end, I think there are other factors anchoring it, for example, fiscal position. I think that will anchor the longer end, but I think the whole curve is likely to shift lower and what we call sort of a bullish steepening, where the shorter end will come down more than the longer end.
A lot of people talk about Europe as the alternative, and it's done quite well, that trade. Can it continue?
I think so. But I think the theme behind it could shift a little bit. First half of the year, a lot of that is on defense. Governments in Europe showing greater commitment to spend more. But I think now the question becomes, okay, everyone's committing 5%. how much of that is actually going to be devoted to the heavy industry sector? Because a lot of these European countries, they do spend a lot of money on pensions or non-defense spending, which they count as defense. And the other question is also on the implementation. So I think we need to look at, for example, the financial sector we do like. Technology in Europe, I think, is great. So I think there are the good themes in Europe that we're looking at, but it's no longer just about government spending more on defense.
Tai Hui, great to have you, APAC Chief Market Strategist at JPMorgan Asset Management. Coming up, we got the view from China's asset management industry on the latest moves around trade and AI chips. We have ZBEN Advisors Peter Alexander joining us in the next hour. This is Bloomberg.
Welcome back to the China Show. Some of the big stories we're tracking right now. An explosion at a U.S. steel plant in Pennsylvania has killed at least one person and injured 10. The company says the incident involves coke oven batteries at its Clairton plant. Now, U.S. Steel CEO David Burritt says that the firm is working closely with authorities to investigate the cause. The plant has a history of accidents and violations, including an explosion and fire in 2010 that injured 15 people. Now, President Trump has named E.J. Antony as the lead of the Bureau of Labor Statistics. That's after firing the previous chief following weak July payrolls data. Antony is the chief economist of the Conservative Heritage Foundation and has been vocal about his concerns with the BLS jobs data and revisions. The position is still subject to Senate confirmation. And the president has used his Truth social platform to declare that imports of gold will not face U.S. tariffs. A White House official suggested last week that the White House would issue a new policy after U.S. Customs and Border Protection stunned traders late last week by deciding that imports would be subject to tariffs. Okay, well, that leads us into the other commodity conversation today, which is in metals.
Yeah, so we're still tracking the lithium space, given the craziness yesterday with CATL halting that production in one of their mines. The latest seems to be iron ore. Not as crazy, maybe, but still, there's Chinese consultancy saying that several steel mills have been told that they need to temporarily halt production later this month. You got to wonder if it's anti-involution, but also they talk about the pollution side of things as well, ahead of this big military parade, too. Yeah, which is,
well, I guess, in this case, I guess the reason isn't as important as the net effect to what it means for taking supply offline. But then we argue the argument still goes back to whether or not taking supply offline will result in the same things that we saw back in 2015, 2016, which I think you were touching on the Citi note earlier on, that the biggest difference between now and then was the property market was doing well in 2015, 2016. So there was a need really for, there was a underlying demand for commodities. And I think the point that Tai Hui was just making right now is when you look at the anti-involution on consumers, the consumer is still not there quite yet as far as being able to backstop demand.
Especially when prices are going up, right, in a lot of these commodities and the like. Certainly that's one thing to watch here as well. And obviously the property market, as you mentioned, right? We did hear a little bit about them removing some restrictions of property purchases in Beijing, but how far does it really go is certainly one thing that we're watching out for as well. Gold, as we talked about, so there's no gold tariff, so at least...
Exclamation point.
Yeah, say therefore.
That as well. Okay, So, gold and home prices, by the way, we'll find out this week on Friday. We have activity numbers, including... this time on Friday, the July sets of new home prices. Anyway, that's just to say we'll be back after a couple of minutes with a full roundup of these markets. Plenty more ahead. Welcome back. You're watching The China Show. You might have seen this on some platforms. Two Chinese ships have collided after one chased a Philippine Coast Guard vessel in the South China Sea. It's the latest dangerous encounter between the two nations with competing claims in this resource-rich waterway. Cliff Venson joins us from Manila to help us understand what happened. So, Cliff, we've seen the videos. Walk us through the events of how this eventually took place.
Yeah, so it happened during an operation of Philippine Coast Guard. It's an operation meant to support Philippine fishermen in the Scarborough Shoa in the South China Sea. And then, usually when Philippine boats operate there, the Chinese ships would attempt to drive the Philippine vessels away. So what happened yesterday when the Chinese vessels were trying to chase a Philippine Coast Guard ship, a Chinese Navy vessel, I would guess, accidentally rammed into the China Coast Guard ship, which damaged the Chinese vessel. So we are starting to see some tensions flaring up again in this part of the South China Sea.
Yeah, quite a bit of damage too, as we saw in some of those pictures as well, Cliff. This latest incident, though, does add to the tensions, as you say. And there was also the president and his comments on Taiwan. Tell us more.
Exactly. So this encounter happened days after the Chinese Foreign Ministry protested against Philippine President Ferdinand Marcos' comments on Taiwan, saying that President Marcos is actually playing with fire when it comes to the issue of Taiwan. But yesterday, despite this protest, Philippine President Ferdinand Marcos reiterated that Philippines could actually be pulled into a conflict over Taiwan because of simply because of the geographical proximity between Philippines and Taiwan. So, and also the president reiterated that Philippines will continue to protect its interest and sovereign rights in the South China Sea.
All right, Cliff, thank you. Cliff Venson there, our latest there on what's going on in the South China Sea. Another check of the markets here right now. We are seeing, when it comes to the onshore markets, doing quite well still, or up about 0.4%. Hang Seng's going the opposite direction. So A over H here today, it seems. Tech seems to be the big drag along that as well. But against this backdrop of this truce has been extended for another 90 days. I guess it was expected. Things are still stabilizing between the U.S. and China. But yeah, and again, we're still looking for some more catalysts out there.
Yeah, we're waiting for that. I think that we have a good story out, in fact, on the tariffs. I'll tie the tariff story and what's going on in the mainland right now. There's one copper play in the mainland actually has come out to be one of the winners. We'll talk more about that, unpack the story even further. That takes us into the commodity story and maybe also the earnings story, where you have Kweichow Moutai coming out with earnings today. That's the big heavyweight, of course, online. We have plenty more on the way in the second hour of the China Show.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session, and we are still continuing to see session highs there as well. We're up about 0.4%. It seems like right now it is some weakness in Hong Kong and offshore. So A shares are catching a bit of a bid here this morning, and certainly our next guest, Peter Alexander, is talking a lot about that. The preference really when it comes to CSI 300. He actually thinks they could outperform some of these developed markers here in the next 12 months or so. He's usually actually based where the live shot is in Dujatway. He's going to be blessing us with his presence here in our studios later on in about 30 minutes or so. And meanwhile, while he's doing that, he's nonstop pinging us on social media, wanting to talk about this. Let's talk about this. Let's talk about what's happening in the onshore market. Well, Peter, you're about to get what you want. 0.4%, CSI 300 onshore lithium stocks, day two. How do we look there? So fantastic day yesterday, double-digit gains, 20% nearly
in some places. And as we can see, we're pulling back, not completely all the way, but maybe just people taking some profits there to the point that Citi was making, I think, on this specific trade, wasn't it?
There were a few battery material makers that they highlighted that said, this could really improve their profitability. Certainly that's one thing to watch as well. But yes, we are seeing them fall off a little bit just here today. But yes, I mean, they were surging double digits just yesterday, right? The likes of Gong Lithium. We're watching pot stocks as well. This is quite interesting, right? So Trump is
not
considering
pots,
drug
plant-based,
drug reclassification. So they're thinking about reclassifying marijuana as a less dangerous drug, giving the whole sector a boost. Even here.
Yeah, that's playing out in this part of the equity market.
Did not know there were pot stocks in China.
Learn something
new every day.
New
every day.
There we go, watching the China show. One thing that hasn't happened every day, in fact, it's the first time it's happening, is the Nikkei 225 is now on track to close at a record high. It's also quite rare. You get a 1,000-point upside on the Nikkei reopening today. And of course, we are going into the last 30 minutes of trade as far as the morning session there is concerned. So that's headed for a truce for today. Speaking of truce, that's the other big story that we're tracking today, the extension to the trade truce.
Yes, the thing that we all expected, I guess, that this was going to be rolled over for another 90 days. So it brings us, to next 3 months of maybe a bit of breathing space. Maybe they're throwing China a bit of a bone here as they try to work out some sort of trade deal, some sort of meeting with President Xi as well as President Trump. But there's a lot of talk about this whole trade approach from the Trump administration now. They call pay-to-play, revenue for exports.
Yeah.
This 15% sort of tax on any revenue that
export tax
from China. It's an export tax, essentially, as what most guests have said, and that is actually illegal in the U.S. Constitution. So there still are legal challenges behind all this, but certainly does undermine the whole rationale behind national security when it comes to trade policy now.
And I think he got asked the question, too, whether or not at some point this might involve, he might be open to Blackwell, which is the most advanced chip, of course. And I think what he said was maybe a not as advanced version as Blackwell if... Unenhanced, if NVIDIA is able to come up with something. I think Min can talk about that in a moment. Commodities, we talked about this already as far as the reflation trade is concerned, and I think one report on... has to do with the weather, of course.
Yes,
less
pollution.
Steel output coming through. U.S. inflation is coming out later today. We have, at some point this morning, in 2 hours or so. What time will the clocks change? Have the clocks changed? RBA
is later on.
Yes, there we go. They're going to cut. And Bank of America Fund Manager Survey, just to mention that too, is one where, interesting, 91% think that this U.S. market is expensive. They don't think it's a bubble.
No.
They think it's a long trade, so I think it's merely an observation of reality more than something that's, I guess, actionable at this point in time.
It's the most bullish they've seen in 6 months.
Yeah.
So whether that continues is one thing as well. But yes, Mag 7, they say most crowded trade, which is not surprising as well. But most say, look, it's not a bubble, but you're starting to see, right, the boost to production, or I should say production, not production.
Inflation.
Productivity.
Okay.
My brain's not working today.
Okay.
But yes, they did say when it comes to the U.S. markets, they're maybe slightly overvalued right now.
Okay. I guess we really need AI in our lives today. I think I need another coffee. Actually, it's only 2. I think it's the weather. I think the humidity is like slowing down our synapses in our brain. Let's get to our top story. More on this. We have President Trump signing this executive order for this trade truce, tariff truce with China. 90 days. It's averted this tariff hike of at least 54% on Chinese goods, which was set to take effect, in fact, in a couple of hours. Let's bring in Min Min, our China correspondent, here to talk us through. It was well priced. It was well expected. So what now is the question?
Yeah, what now? So another 90 days, I guess it buys them more time to negotiate some of the finer details because President Trump already hinted at what he wants, which is a quadrupling of Chinese purchases of U.S. soybean. Obviously, U.S. had been kinder to China so far, especially if you compare to other countries like India, the doubling of tariffs there because of India's purchase of Russian oil. So far, that threat has been leveled at China as well, but the U.S. hasn't acted acted on it yet. But they have 90 days more to talk about this. Potentially, Trump and Xi is going to meet during this 90-day window for an in-person summit, potentially during the South Korean APEC meeting in October. And of course, China has for a long time been wanting to get rid of that 20% tariffs on fentanyl. They also want to get access to more chips from the U.S. as well. And here's the latest that President Trump had said about the Blackwell chips from NVIDIA. Have a listen.
I deal with Jensen, who's a great guy, and NVIDIA. The chip that we're talking about, the H20, it's an old chip. China already has it in a different form, different name, but they have it. Or they have a combination of two will make up for it and even then some. The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible I'd make a deal, a somewhat enhanced in a negative way Blackwell. In other words, take 30% to 50% off of it. But that's the latest and the greatest in the world. Nobody has it. They won't have it for 5 years. But the H20 is obsolete. You know, it's one of those things, but it still has a market.
So he is willing to maybe roll back some of these chip curves on China. In some ways, it's like you can basically pay in return for some trade concessions here, which is unprecedented, right?
Yes. So he already set this new precedent with NVIDIA and AMD, where they would pay about 15% of their China sales revenue in exchange for the export controls. And this really shows that maybe that red line that the U.S. used to have on national security, maybe it's not so red anymore. And for the right price, maybe the U.S. is willing to roll back those chip curbs even further. Now, the question now, though, is will China accept that? Because remember, China has been putting out a lot of these statements through its state media opposing these backdoors that have been installed on these chips, or at least, well, the Trump administration officials have been calling for the installation of these location tracking capabilities in these chips. And so China had been opposed to some of the security risks associated with that. They have also been putting out statements about how the H20 chips had been, not very advanced. They're not energy efficient. There's no reason why Chinese consumers should be purchasing these chips. But maybe with the Blackwell series, that is a more advanced line of product. Maybe that would be enough to convince Chinese consumers to get their hands on these chips. So maybe both sides could be bought off by, with something more valuable to trade off for the national security risk there.
All right, Min, thank you. Min Lo there, our China correspondent with the latest on this trade truce. Still ahead on the China show, we have ZBED advisors Peter Alexander joining us there just for insights on how he sees, and he's been talking to a lot of asset managers there in China as well, how they're viewing this trade truce extension and, of course, a tech tussle between D.C. and Beijing, and why he says CSI 300 could outperform developed markets in the next 18 months. This is Bloomberg.
Okay, welcome back. We are in the thick of earnings season. It's some big tech names coming through this week. A lot of big ones today. Not so much tech, I guess, but you have a lot of consumption-facing names. Let's bring on a team for a preview of what to expect here. We have Shirley Zhao, our conglomerate's consumer and gaming reporter. And also with us is our earnings specialist, Rachel Yeo, to talk us through, of course, some of the consumer staple names that are coming out today. Shirley, I'll start with you. What are we expecting? Galaxy is on deck today.
Yeah, so Macau casino operators had a pretty good quarter in the second quarter. And overall, the industry's gaming revenue recovery was the best post-COVID. And the industry overall is expected to grow about 4% in profit. And Galaxy Entertainment specifically is expected to grow about 11% in EBITDA.
Okay, tell us a bit more. I mean, we talk about there's been a lot of concerts and the like that's happening there, but why do you think the gaming sector has been so strong the past few months?
So the main reason is that the big gamblers are going to Macau more often and are gambling more. And there are a number of factors contributing to that. Macau's casino operators have been rolling out more luxury hotel rooms, including Galaxy Entertainment. And they have been organizing more non-gaming activities like concerts concerts and entertainment shows, and those have helped draw foot traffic to casino resorts. And China has been relaxing travel rules over the past few months for Macau, like allowing people from more cities to apply for individual travel visa. And overall, the sentiment is just better, probably due to the good recovery of Hong Kong and mainland China stock markets.
Yeah, I mean, speaking of stock, right? Galaxy's up 19%. The group is actually done very, very well. What's the outlook then? Is the outlook getting better than fundamentals, I guess is the question here.
Yeah, so I think it remains to be seen how long this gaming revenue boom will still last, because the broad China economic situation is still in a slowdown, and Macau is also tightening restrictions over gaming rules over the past few years and months. So it remains to be seen how well the recovery will last.
Okay, Shirley, thank you so much. Let's get to Rachel now. You're watching Kweichow, which is, I guess, the outlook's a little bit different than what you see in Macau. There's a lot of pricing pressures, and a lot of it has to do with what we've been seeing from the government and the campaign efforts there. But what are you expecting this time?
Yeah, so for second quarter earnings for Kweichow Moutai, we are expecting to see a slower earnings growth compared to the first quarter. So this also reflects slower consumer demand and also pricing pressures, as you've mentioned earlier. But despite this, gross margin is still expected to remain steady for now, thanks to disciplined cost management despite the slower consumer sentiment out there. And Moutai's full year sales target is also poised to reach. The company is poised to reach its sales target, despite all the pressures as well. So but compared to other baijiu rivals, Moutai is also expected to outpace its rivals. Maybe other baijiu companies may record either a profit or sales decline or just a marginal growth. So this could continue to underscore Moutai's leadership in the baijiu segment.
There's been some tightening in terms of government employee entertainment and activities and what they can do there. How might that affect baijiu, generally speaking, the baijiu market, which might be part and parcel to that?
Yeah, so definitely the impact from China's austerity drive from alcohol sales will continue to be reflected in Kweichow Moutai's earnings and also across other baijiu earnings this quarter. So far for Moutai alone, we are seeing wholesale prices for its Feitian Moutai, which is the company's flagship product. The wholesale prices of that has fell year to date. So this also reflects pressure in the secondary markets amidst Beijing's anti-extravagance push. And wholesale prices for Moutai, which is actually a big indicator for the overall baijiu market and also the consumer sentiment, has also been seeing signs of recovery so far, although that has yet to meaningfully recover amidst the policies that have been going on. So investors and analysts will continue to keep monitoring its wholesale prices in time to come.
Rachel, thank you so much. Rachel, you're there, our earnings specialist, ahead of the Moutai results set to come through, of course, over the next few hours or so. And speaking of the other name that we just touched on there, on Thursday we'll be speaking exclusively to the COO of Galaxy Entertainment, Kevin Kelly, really unpacking the earnings, plus the outlook. And really one story is what does the outlook look like given how good things have been the last few weeks or so. At those times, on your screen, stay tuned for that exclusive with Haslinda Ahmed. Plenty more ahead. This is Bloomberg.
There's not a lot of time for these negotiations to proceed, so I think it's extremely important that that both sides have agreed to a tariff rollover, so now they can really put their energies and attention on the key outstanding issues, including export controls, critical minerals, excess capacity, you name it. There's lots of issues on the agenda and not a lot of time to come up with negotiated solutions.
I think this is going to be the new normal we're going to face as we move forward. I think President Trump is going to continue this practice of every time extending this deadline for 3 months. And he's using this as a bargaining chip, essentially. This time he said he wants China to quadruple the purchase of soybeans, and I think next time he's going to say something else. It's quite interesting to see that he didn't demand China stop buying Russian oil this time, as he at the same time slaps a 25% on India for doing the same.
Just some of our guests these last few hours or so reacting to the latest news here of this 90-day extension, this window that takes us into really, so is it September? My brain's not working today. October, November.
November now.
Which it really puts us on track timing-wise for a possible meeting between the two at APEC.
At APEC, yeah.
Right? Okay, so let's see if that's possible. Peter Alexander, the founder and managing director at Zeban Advisors, usually based in Shanghai, has blessed us with his presence here on set. They provide advisory services to China's asset management industry. Okay, why don't we start with geopolitics? That seems to be the topic of the decade.
Let's go.
Where do you think this leads to? What's the end game, you think?
It's the same end game that it's always been, going all the way back to Liberation Day, which is the bellicosity and the bravado that's been coming out of the Trump administration has been, for me, quite astounding, because ultimately, what leverage does the United States have? And I have to say, this whole concept of the clutching of pearls within the United States about how dare America and the Trump administration sell H-20 chips to the Chinese. You're giving away the AI advantage that America has. They had no choice. Rare earths was desperately needed within the United States, not just in the auto industry, the electronic magnets, but the Defense Department needed it. So this was a quid pro quo that was required, and this, we think, is going to continue as the Americans really wake up to the fact that after 30, 35 years of exporting all of this manufacturing capacity, what is the next step? Cooperation, dialogue. America and China have to work together.
So it really undermines, as we're talking about, this whole rationale of national security, which seemed to have been that red line of why they couldn't ship chips to China now. That seems to be threatened. Does it prompt then the White House to target other industries and other goods as well as bargaining chips?
You mean Chinese goods?
Chinese goods.
Yes. If it's not this, where does that
where
focus
else
go?
do I look at now?
What else is there? That's the real issue. I mean, if you think about it, the comment that I've been making to everybody is, what is it exactly that the Americans actually produce? Everything right now, for the most part, not only is produced in China, but is produced at such scale and at such efficiency that even if you were trying to onshore or bring back manufacturing in the United States, you have at least a decade to get it done. How can you do it that makes it worthwhile? iPhones, $3,000, $4,000 per iPhone, whatever the case might be. I don't see as though that there's much in the way of targeting, as you call it, within the U.S. But here's the other side of that coin. What else does China have up its sleeve? My outlook has always been, China's not even begun to play hardball if they wanted to. Look at the pharma industry, things like antibiotics, precursors. The United States, the Chinese, if they truly wanted to, they have a host of other areas that I believe the United States is truly dependent upon. And I believe they've been very reticent in terms of, let's be smart about it and continue the dialogue with the Trump administration, which has been fantastic.
Does that eventually lead to a lower tariff on China than the U.S. has set on almost everyone else? Let's call it 15%.
Exactly. They're still at a weaker position because it seems like all these trade deals with other nations are low.
No,
lower.
Absolutely. I have no idea how the trade tariff sort of baseline will come out. But I think it is very interesting to watch the dynamics between the so-called BRICS nations. Because, I mean, look at India. I mean, out of nowhere, India becomes the whipping boy. 50%, they're targeting India because they're buying oil from Russia.
Not China.
Yeah, China's the biggest buyer of oil. And then the interesting thing is, look over the last several days. You've got Lula talking to Modi. You've got Xi talking to Putin. You've got Putin talking to Modi. They're all coming together. So it's that joke about, the actions you try to take on a path to stop an outcome, you ultimately end up achieving that outcome. Like the dollar or the United States hegemony is now got these four massive economies that are saying we need to continue to work together. So it's not a great place, I think, for the Trump administration to be right now.
Yeah. the other phrase for that would be the global south, right?
Correct.
The broader concept. How does it feel on the ground in China? Does it feel, and you've been there for how long? 20 plus years?
30 years.
30 years now. Has I won't say the mood, have the dynamics and the relationships changed from one where 20 years ago the big thing was China entering the WTO and the U.S. making a big deal out of that? I mean, have those relationships changed on the ground to one that is more oriented towards everything except the United States?
I don't think so. I think that, broadly speaking, the sentiment is kind of, it's Tuesday. It's like it's not really something that is in the zeitgeist every day in the media and
It's not a thing.
It's not a thing. People are just trying to go to work, trying to pay their bills, trying to take care of their families. But the sentiment locally has certainly changed since last year. I would say this time last year was probably, in retrospect, peak pessimism in China. You remember how chaotic the snowball correction was in January, and then it was all of summer was really, really weak until October. This year we've had DeepSeek, we've had Nujia 2, we've had Labubu.
Yeah.
We've had this huge sort of cultural renaissance taking place in to put a real spring, I would say, into the step of the Chinese. It's been great.
Okay, we'll talk more about that.
Yeah.
What's going on onshore in markets as well. Peter Alexander, founder and managing director at ZBen Advisors, is staying with us as well. Some other stories that we're following for you today. Ford has unveiled a $5 billion plan for a new line of budget electric vehicles. A plan, I should say, starting with a $30,000 pickup truck set to roll out in 2027. Now, the CEO, Jim Farley, calls it a bet to take on Chinese rivals, warning that there are no guarantees in the unpredictable U.S. EV market. The plan includes a $2 billion overhaul of Ford's Louisville plant. Paramount is buying the exclusive rights to show all events from the Ultimate Fighting Championship in the U.S. The 7-year deal is worth $7.7 billion and bolsters the Paramount Plus streaming service. UFC owner TKO Group jumped 10% in New York, and Paramount says it will also look at buying international rights in the future as they become available. Micron has raised its fiscal fourth quarter sales and profit outlook, citing stronger DRAM prices and high bandwidth memory demand. Revenue is now seen up to $11.3 billion, with earnings as high as $2.92 a share. Shares closed more than 4% higher, and Micron has one of the best performing chip stocks this year, one of the best.
Okay, let's have a look at, speaking of chips, Asian chip stocks on your screens right now. Oh, the angle to the screen is actually quite interesting. Okay, we're now up 9.5% there on Kiosia, which is listed in Japan, which is really a reopening story as well in Japan, which is why perhaps we're getting incrementally more gains there. Going into the close of the morning session, just under, now close to under 3 minutes away, we're now poised for a record close on the Nikkei. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break as well. It's been a pretty good catch-up story when it comes to what's going on in Tokyo here today. We talked about the Nikkei reaching those records there, and quite rare to see a 2.5% upside there for that gauge here. So rising to a record for Japan here today. Of course, as we count down to that U.S. CPI print later on in the U.S., Dave.
Yeah, and what that's going to hold, incrementally more signs that inflation is being pushed through the system, and ironically, something that not just the Fed is seen to be ignoring, but maybe taking that as a sign that they might need to sort of pull the trigger earlier on as far as September is concerned. It takes us to, right, so we're talking about superlatives, right? So 43,000 on the Nikkei takes us back here to Shanghai Composite, which, by the way, I know it doesn't sound like a lot, 36.61, but that's a level on price that we actually haven't seen since 2021. In fact, just a 2% more, 13 points, I'd call it even 1.5% more. That takes you back to 2021. Beyond that, it's 2015. Now, I know what you're going to say. If you expand the chart even further, that's going to go up substantially because of the bull and bear market and bust, which then follow there. But that's not the point. The point is, of course, this has done well. And you probably didn't hear about this as well. All right, so the question is, why has the Shanghai Comp really taken the attention away from the CSI and, the other usual benchmarks that we track, MSCI China, Hang Seng Tech? And it's really because, and I'm just using this as a representation of the banks have done very, very well. Dividend trades, long income, for example. And as you can see, over the last 12 months, it's done better than almost any other trade. So that's actually lifted the white line. And that's done better than the NASDAQ index as well, right? And I guess, Yvonne, the question is that a defensive trade, on the barbell strategy? Is it the defensive and then you go long on the growth stocks? Or is that actually an indication of underlying risk appetite actually starting to really pick up?
Yeah, that's a key question. Let's bring that question to Peter Alexander, founder and managing director at ZBen Advisors. You've been talking about what's happening on the ground and how really sentiment has really shifted to risk on among Chinese investors.
It's beginning to shift to risk on, and I think, David, the chart that you just put up is fantastic, because if you look at the CSI Bank Index, it's sold off in the last month and a half. Yeah. And the bank index, because of the dividend trade, was actually one of the more popular trades by the Chinese retail or Chinese investors broadly, because they were looking for something that was a little bit safer. And if you looked at yields were plumbing lows, so on and so forth. And there's been a reversal of late. You're starting to actually even see the 10-year yield is starting to slowly pick up. Yep. Now, why is that? Not because of deflation or anything, but so much money has flowed into fixed income instruments in China that when it flows the opposite way, flows out, it actually has an impact on an increasing yield. We were talking earlier before we went back on TV that look at Hong Kong. Half of the volume in Hong Kong this year through Stock Connect is the real trade that people need to pay attention to. We think that there has been an ultimate shift of risk off to risk on, and you talked about the Shanghai Composite. I'll make the statement that right now you're going to see the CSI 300 radically outperform developed markets, including the S&P, over the next year. The world's most hated trade. I'm down here for a whole week trying to explain the opportunity that China has for equity investors. Look at liquidity globally. Nobody wants to hear it. Nobody wants to hear anything about the opportunity that Chinese A shares have for asset allocators.
What's the case for A shares? Because most of the liquidity, to your point, has so far come to Hong Kong, though.
Yeah.
Like, what will change in your view?
Well, predominantly it's a relative valuation. I mean, global investors to begin with, rational individuals. You were talking about the Nikkei at an all-time high, the DAX at an all-time high. Everybody's at an all-time high, and yet I think the Hang Seng is still 20% off the all-time high, and the CSI is 30-odd% off the all-time high. 13 times trailing earnings versus, 30 times trailing earnings elsewhere. Right. So I think rationally, investors, both locally and globally, are going to just wake up with this flood of money from liquidity and say, where's the next great trade? China's going to be it.
Is the earnings momentum there? Because when you talk about U.S. markets, that's where people say, I need to stick to the Mag 7, the Liker, because I'm still getting that resilience in earnings.
It's visible.
Yeah. No, that's the big question of the fundamentals. The fundamentals are uncertain. There's an inflection point, or I should say multiple inflection points throughout the economy, whether it's property, deleveraging. Can the shift from old economy to new economy happen? I mean, one of the comments I've made to groups is DeepSeek 2.0 is coming. And when it comes, that could be a catalyst. You may follow this robotics company called Unitree. That's going to list soon. That could be a catalyst. But I think the ultimate catalyst you alluded to earlier, Yvonne, is going to be when Trump and Xi Jinping meet, and there's going to be I call it the Taiwan for TikTok tariff agreement, where they're going to come to some agreement. They're going to highlight what's going on with Taiwan. Trump's going to get ultimately his poison chalice, which is going to be the TikTok platform. That, I think, is going to ultimately be the real catalyst going into next year that will get people interested in China.
The message, though, is, to the point, you're here trying to market that message.
Right.
Your audience, though, the incremental buyers in the U.S., I mean, part of the audience here understands that, I think, already. Yep. And I wonder, I think, two-part question. One is, how receptive has the audience been here in Hong Kong? And how receptive do you think the audience will be across the Pacific to the China story?
The Hong Kong investors, broadly speaking, understand it, but still are very reticent. I'd rather just stay in Hong Kong and get my play that way, which is understandable. So you can imagine that if I were to extend the conversation even to Europeans, God forbid the Americans, I've had clients tell me, look, Peter, we can't even raise the concept of a China allocation with our institutional investors. They told us if we do so, we'll get fired. Because it's that much of a the so-called hated trade. I think over time people are just going to forget their priors. They're going to look at the opportunity and they'll start slowly, quietly reallocating back into the mainland.
Is it just because they've just been burned so badly before? It's still the scars from that?
There's a little bit of that, but it's predominantly the headlines. If you're in the United States, in New York or Boston or Chicago, and you're being pounded by exit bans and all of this nonsense, why would you, career risk, why would you add anything? And if you do, just go to Hong Kong. That's a little bit easier, which is why I think you've seen some, but I think over time that will gravitate back to the mainland.
What do you make of this anti-involution conversation, and whether or not that brings back the earnings that we were just making the point that isn't quite as evident just yet?
So the whole concept of supply, right, which is the way that I try to talk about it, anti-involution is just very Chinese wording. This is, China competition 101. You have 5 or 6 or 10 companies come into an industry. This has happened for the longest time. Do you remember the rental bike industry? Yes. There used to be like 10 of them. Ultimately, what happens? They fight it out. Then the government comes in and says, okay, we're going to start putting up new barriers. You have to then address those barriers, which is what we're seeing now, let's say, with EVs. And then after that, you typically come down with 2, maybe 3 really strong competitors. So this is not anything new. I think it's just a center of focus because of the whole China overcapacity concerns that are being addressed globally. But I've seen this on a host of different industries over the last 30 years.
Right.
This makes, I think, raw, brute force competition makes the Chinese just stronger. So they're going to move from market share grab to earnings. How long it takes, that's what I think the analyst industry has to really focus on.
Yeah, I mean, diamond sharpens diamond, right?
Correct.
You take the domestic name outside. But the question, I think, when you look domestic, I think I'll use the bike analogy that you just made. We put out a story back then where it was this graveyard of used bikes. And the question is, do we wait to that point where they just kill each other? Or do you need to step in and save some of the margin and earnings? And is that starting to show up, extreme competition in EVs? We know that. Financial services. Yes. Like, what's your take on what's going on?
Well, it's interesting. When we're trying to look at what potential catalyst you might see over the course of the next several months that would lead to demand for A shares, it is M&A. You mentioned financial services. We had 2 major securities companies merge.
Right.
We're looking at shipping. Massive shipping merger happened. What was it, 6 months ago now with Costco. We've just seen, I think, a chip business that was merged, a couple of them. So I believe that there is a learning from last mistakes within sort of the governing policy members. And they are stepping in right now to try to get to the point where this does not become a massive issue, overcapacity, prices decline, you name it. Again, the real issue is, can they get it done in time? People have to make up their own mind.
Okay, you're making this pitch to investors in Hong Kong. What is the pitch then for A shares? What's the sector? What's the trade?
I think we're not looking specifically at stocks. What we're looking at is either beta or alpha.
Okay.
Which is, we think all investors, if they do not have an allocation to A share, renminbi securities, they should be at least going into some sort of beta play, whether it's a CSI 300, MSCI China, whatever the case might be. Yeah. However, if you look back at 2021 or 2015, or even, God forbid, 2007, this is a market that was made for active managers. So if you're out looking for mandates, you should be looking and talking to all the big managers, because there has been a demonstrable ability to deliver in excess of these indices. But having those conversations, Yvonne, right now is impossible. People just don't want to, they don't even want to entertain the idea.
What do you hear?
For you, Peter.
Yeah, oh, you have, and it's only day 2.
Well, let's hope DeepSeek 2.0 comes. What are you hearing on that?
I literally, there are rumors bubbling about that it's this week.
Not to speculate, but yes.
No, I genuinely think it's something that will probably happen in September. I believe Liang and the team over there are a little bit smarter when it comes to the timing of it. And if you look just in the past week, I think the folks at OpenAI had a very hard week trying to go open source. And this is a subject for another day, but watching this pitched battle between closed and open source models between the United States and China is fascinating. I did not, as they like to say, have on my bingo card, China was going to be the driver of open source AI. And ultimately, how is it that this closed source system is going to be a viable, scaled business going forward? I joked with a client yesterday. I said, Steve Case, showing my age, called up and said he wants his AOL business model back because it's a closed garden, right?
Yeah.
And that's whether it's Anthropic or OpenAI or XAI, they're predominantly closed architectures. China just iterates and iterates and iterates every single day, every single week.
Peter, enjoy the rest of your trip. Obviously,
I'll try.
It's great that you stopped by. I remember we asked you, say, I'm tired.
Yeah.
Peter Alexander, founder and managing director at Zeben Advisors. It's interesting, right? As we were talking about Trump and this obsession over BRICS.
Yes.
We are just hearing from CCTV that President Xi did hold a phone call with the Brazilian president, Lula. So Yes.
Waiting on
Speaking
details
to what
still.
Peter mentioned there, right? This whole geopolitical maneuvering that we're seeing here. Coming up, we'll get more commentary on trade. We're speaking with a former assistant to U.S. Trade Representative Claire Reed, now senior counsel at Arnold & Porter. That's on Insight with Haslinda Ahmed. This is Bloomberg. All right, we got the RBA decision coming through in just a few moments as well. Okay, all 36 economists in this Bloomberg survey expect the RBA
So there's nothing to talk about then.
the cash rate by 25 basis points as well. Okay, there's a lot of questions. There's going to be a hawkish cut and all that, right?
How complicated we've made life.
And really the comments involved in this, right? This is as we start to see the labor market data suggesting there's more slack than the central bank had projected back in May. So also predicting a cut today is, of course, our Bloomberg economist James McIntyre. James, the RBA surprised the market 5 weeks ago by holding rates steady. You were not shocked. I think you were one of the few that said that they were going to hold. What's leading you to expect a rate cut from the RBA today?
Yeah, thanks so much, Yvonne. So last time around, we thought the RBA was going to stay on hold, and the reason why was because the labour market was looking very tight. And even though they had a monthly inflation figure that looked a bit soft, it really wasn't quite clear that there was a big burning need for the RBA to cut. There was nothing forcing their hand at that point, so we thought they're going to take their time and see what comes out. And what has come out since the July meeting over the last 5 weeks has been inflation data, the full quarterly CPI that was in line with what the RBA was projecting. So tick, giving them the green light there. But what happened on the labour market was actually quite interesting. That tight labour market that they had in July, the Stats Bureau gave them a set of revisions. Now, labour market revisions are something that are a bit controversial around the global economy these days. No one got fired in Australia, but what it will do is it will fire up the RBA's forecasts, making them revise the unemployment rate higher, and that could lead to a little bit of a softer inflation outlook. And that pretty much, in our view, and that's the view that's shared by everyone, it seems, should be enough to guarantee a move downwards from the RBA today.
James, how clear-cut is the outlook beyond the meeting today? Are there factors that might offset this, I guess, well, at least for the meeting today, this unanimous understanding that rates are going to fall in Australia?
Yeah, there is the view that there is further to go on rates, and the RBA has told us that themselves. This rate cut today won't be enough to get cash rates back to neutral or into stimulatory territory. So the RBA will say that it's still contractionary, but they will also say, likely in their commentary or any sort of forward guidance, that it's going to be, they'll still be a little bit hawkish and quite circumspect, very measured, and saying that, they're going to be very data dependent and cautious from here. So we think that there's further cuts. What's quite interesting within the economy, or what's the RBA balancing there, is that the last couple of years we've had a very public sector demand-driven economy, and 2025 is the year that we're hoping that rebalances with the private sector momentum taking off, consumer spending and business investment. Things looked pretty good until we got a bit of a shock, the same shock the whole world economy has gotten in April following the Liberation Day tariffs. And so there's a little bit of worries that uncertainty shock there could see consumers and businesses sit on their hands and maybe not deliver that upswing that we're hoping for. So that's what the RBA is kind of juggling there. If we don't get that upswing, it's likely that we'll not only see the RBA moving again later this year in November, but perhaps cutting some more in 2026.
James, thank you so much. James McIntyre from Bloomberg Economics in Sydney for us ahead of the RBA decision. Right, and for our Bloomberg subscribers, you can turn to your terminal for more context when, unless a meteor hits before that great decision comes out. Of course, when that decision comes out, commentary, news lines, and context as we try and figure out, of course, what the next move will be out of the RBA. Check that out on the terminal. Plenty more ahead. This is The China Show. Welcome back. Some global headlines we're tracking today. President Trump has named E. Antoni as the lead, the Bureau of Labor Statistics after firing the previous chief following, we all know, of course, weak payrolls data for July. Now, Antoni is chief economist of the Conservative Heritage Foundation and has been vocal in his concerns with BLS jobs data and revisions. The position is still subject to Senate confirmation. Okay, now the president has used his, and we're talking gold and tariffs now, his Truth social platform to declare that imports of gold will not face U.S. tariffs. A White House official suggested that last week that the White House would issue a new policy. That's after U.S. Customs and Border Protection stunned the markets late last week by deciding the imports would be subject then, at that point, of course, to tariffs. Now, President Trump has reversed his criticism of Intel CEO after talks at the White House. Trump described their meeting as very interesting, calling Tan's success and rise an amazing story. Now, last week, the president called for Tan's immediate resignation, accusing him of unspecified conflicts of interest. Now, two Chinese ships have collided after one of them chased a Philippine Coast Guard vessel in the South China Sea in the latest encounter between the two nations in the disputed waterway. The Philippine Coast Guard released video and photos of the incident and said to show a China Coast Guard vessel hitting a Chinese Navy ship. Now, the Philippines says the China Coast Guard ship suffered substantial damage.
Yeah, and that's certainly what we're watching when it comes to how Chinese media is covering this event here today. There is no mention of the Chinese ships colliding, but state media does report, are quoting the China's Coast Guard spokesperson saying that they took all necessary measures to drive the Philippine vessels away, and that the operations were carried out in a, quote, professional, standard, and lawful manner. The spokesperson also says the Coast Guard will continue what it calls rights protection law enforcement to protect China's activities.
Now, the incident is sparking mostly nationalistic reactions on Chinese social media. It's time to change our tactic is one comment, among many, of course, there. Forbearance and concession only makes your enemy push the envelope, and it's time to punch them. Now, if only talks and warnings are useful, the Philippines would not offend us again and again. They see that we don't dare make any moves, so they keep challenging our bottom lines. And next one here shows that you didn't give him a beating earlier, and now he came to make trouble every day. This time we lost face by two ships hitting each other. Yeah, which is, I think, interesting to your point that we've seen this really on many, many social media platforms. Covered in different ways, of course, is the other point there.
Yeah, and it's interesting, right, where this coincides with the fact that we're starting to see this flare up a little bit more now in the South China Sea, and coincides with what the president had mentioned with his comments about Taiwan, and basically saying that due to just the proximity of the Philippines and Taiwan, that they might be dragged into this, if there is ever a war over Taiwan. And certainly, so tensions are certainly flare up once again.
It was, yeah, and I think I caught the latter part of the briefing, I believe, from the Philippine president, and I think he was responding to a question, and I'll correct myself, by the way, if I'm remembering the sequence of events not quite accurately, but he was responding to a question that was posed to the Philippine president on comments made by from the Chinese side that the Philippines is playing with fire. I think his comment was effectively, what fire, to your point that you're making, it's just that the fact that they are next to each other naturally means, of course, they will be part of any conversations around that, of course.
Yeah.
Anyway, well, we can leave speculation there for now. But yes, that is what we've heard so far and you can see the video for yourselves, of course, across social media. Right, from ships to chips, we're looking at that as well, given, of course, Asian chip stocks and the move that we had and the confirmation coming out of the U.S. president, 15%, right? Export tax, whatever you want to call it there. Chip makers across the region are up. Japan in particular, because of the catch-up trade there on the back of Micron earnings and also NVIDIA news coming through as well. Lithium stocks, day two.
Yeah, they're not doing as well. Obviously, yesterday we saw double-digit gains like of Ganfeng Lithium, Tianqi. We're coming off that now on what happened with that CATL halting that mine output there as well. In terms of the Shanghai Composite and what we're watching out for here today, certainly it is doing a little bit better than Hong Kong. That was certainly what we have seen. We come off some of the highs already in the session. But then again, as Peter Alexander said, it's the market to watch is A shares. Set to, as he says, sticking his neck out, is going to outperform developed markets, including the S&P, in the next 18 months. He says the catalyst, wait for DeepSeek 2.0, wait for the Unitree IPO, and of course, more stabilization if there is some sort of trade deal between the U.S. and China.
Yeah, the stars are aligning for that, including liquidity, which he says is fair and abundant on the Chinese mainland. It's a message, he says, that still isn't landing with most people, but I guess that's really where you are as far as getting alpha. And to his point, if you're more conservative, beta, of course, by the benchmark. To his point. Yep, so that's it from us. If you missed that conversation with Peter Alexander, you can turn to TV, go scroll back for that and others that you might have missed. We'll see you all tomorrow. Thanks for joining us today.